everybody. Welcome to the Closing Beat. Happy Monday to you. How you doing out there? All's good? Did you have a good long weekend? It's a long weekend. I got that wrong in our notes from Jazz. I put it was a shortened weekend. I don't know. I get them all confused. Anyways, we're financial advisors here at Jazz Wealth. Hope you'll check us out at jazzwealth.com. We are constantly going, man. We got our weekend letter. We got Wine and Wealth. Last week was a great one we did with an insurance specialist, Chris, no holds bar kind of discussion about how insurance companies make money, how you can get the best deal with insurance, and how do you decide how much and all that. Really cool to get that kind of transparent insight there. We'll be doing Wine and Wealth again this week as well. And so, yeah, it's just, it feels like it's later. Like it feels dark already in some ways. But anyways, we're going to talk about the stock market here today. Cody, we have a winner. Do we not have a winner?
We do have a winner.
Finally.
Yeah. Your winner from last week, your first winner in 2 weeks, is Marissa I. She is your winner. She won $100. She is not a client, but she will be getting $100 from us.
Very cool spelling of that name. Is that in fact how you spell it?
Yes.
Melissa.
100%.
Melissa. I love it. Congratulations to Melissa. Finally had a winner. Last week we didn't have a winner because the market went down, right? So that was the case there. While other advisors are playing checkers, we are playing chess here, in particular with the clients that work for IBM. You guys have some changes going on there. We have actually had quite a few clients going, help me out with this RBA stuff, man. What do I do? How does it change your retirement plan? What? For God's sake, Cody's looking at himself. So we've been helping out with that and finding out how many of you actually do work there. So small world. Anyways, let's talk about the stock markets here today. Today was basically a breathing type day, a catch your breath, put your hands on your knees and go, whew, that was a long run up. Right? And what we talked about this before with gold. You run up a hill that's really steep, you're going to need to take a break. See the break going on here? The same is probably true, at least in the very, very, very short term for the S&P 500. Like I said, mostly just a slight back and forth day. No real news to get excited about, nervous about. A lot of earnings going on out there. Last week was, in fact, the best single week of the year for the S&P and the NASDAQ. It was the best in 3 years, which, comes at a great time for the Russell 2000. Best week in 3 years there. I might also add something that we've shared a while back. Years where a 10% pullback ended. I shared this with you in the past. We said October holds the record for the best month for a 10% pullback to end. Here's all the numbers for how many times these pullbacks did end in those months when there was a pullback. 18 times. Well, you can add another one to it. 19 times officially for the S&P. If we go back over to the S&P, that's the end of your bottom there, your 10% pullback, just a touch over. And we've got that there. So very, very cool. Remember that the best days and the best weeks in the stock market come at the worst time, normally, right? So I've shared this with you in the past here. The best days in the stock market, here they are, right? The top 20 best days since going up to the end of 2022. Notice that a lot of them are 2008, 2020, was that right there? COVID, oh my God, COVID is going to end. 2009, 2020, 2008, look at that. Notice how there's no 2015, just in the middle of an uptrend, or 2019 before COVID. Yay, we just had a 7% up day. Doesn't happen. The best days come after the worst, And the same is true for weeks. So we got a fun little study for you here today before we go into the stock markets. What happens if you, just since 2010, you missed the best week? So in other words, here's this year, right? Last week was the best week. What happens if you missed that? Well, if it came at a worse after a bad week, you would think, I probably didn't miss out on much. Had a little fun with this one here. So since 2010, if you had invested in every single week, $100, just left it to see how much it could grow, the $100 would have turned into $390.85 as of last week. If you missed the best week of each year, in other words, just take 1 week out, whatever the best one was, remove that from the returns, you actually have less than half of that. So it tells you a few things, and there's obviously 14 of them there. It tells you that the best returns come in about half of the best returns come from just 14 total weeks if you look back to 2010. You can make an argument, though, that what if you missed the worst weeks, right? So instead of missing the best week, what if you miss the worst week? But then the question is timing. Like it's very, very difficult there. So from a timing standpoint, you're trying to get in and out of the market and find your way through things. It can be stressful, right? Because you happen to miss that best week and you really start, you start from behind there. So that's what you got going on with the S&P there. Emotions cause different returns. That is true. That's where people start to separate in terms of their account performance. All right, moving on here. We've got the NASDAQ, of course, nice and strong, back to the highs today. Also take a break. Hey, I had my best week ever last week. Oh, great. Take some time off. Same thing in real life there. You got the Dow doing the same thing. I don't know. I'm just going to keep saying that. I don't know. The Russell 2000 doing the most movement last week. So therefore you would expect it to take a break. You know what I mean? Come back a little bit. Most people now at this point will be looking for the higher low. You would not want, nor would you expect, the Russell 2000 to revert all the way back down. Just give it all up. As fast as it gained it, give it back up. It's possible, but that would be a very, very rare scenario. So everybody's looking for the higher low on that one. On Friday, we had a Fed president, Raphael Bostic, came out. He's like, what were his quotes? I put his quotes down. We have to think about moderating policy down the road. He also said, we may support holding rates here for about 8 to 10 months. These are pretty specific comments. He said that a policy shift would be warranted before inflation hits 2%. Those kind of contradict each other just a touch a little bit, but don't be surprised now if you see the Federal Reserve start cutting rates earlier than expected, which goes back to what we just saw last week. Remember, I said, I'm kind of shocked that there was like a 2% chance of people cutting rates. Well, if we look over at the change for May, and I put it on there so you can see, you can actually look what the odds are for month by month. So going into the May meeting there, you now have a 43% chance that there will be a rate cut based on one guy's comments, man. Isn't that impressive there? So investors, analysts, everybody quickly saw that obviously on Friday, took their positions, adjusted and everything. And you had this sort of rip-off rally on Friday, largely just following up from the days before. Today, bonds taking a little bit of a break, meaning rates went just a touch higher, but we are happy to see bonds off of lows. Now, remember, anytime you have a very, very large decline in a stock, a commodity, a currency, whatever it is, you have people that have held that asset and have a loss, right? So they need a reason to take a smaller loss, meaning a rally, or decide to just wait for a break even. So as you have, let's just pretend this is Apple or something. As you have this rally, this guy right here still has a loss. This guy has a loss. This guy has a loss. This guy has a loss, right? So as you have these rallies, it's going to be very, very natural for people that are over here to say, okay, well, that's a smaller loss than it was down here. I'll just sell some of it and walk away. These people over here going, oh, fine, we're getting a little bit of a rally, I'll sell some of it. So it's very hard for something that's fallen consistently and for a long time to just go, bam, right back to highs unless there is a buyout of some sort, which in this case, it's bonds, right? So we're not talking about that. Anyways, that's basically looking around the market. Everything else a little bit quiet. We just talked about gold a second ago. Here's oil, just slowly and choppily retreating. Remember, this is a survey. We talked about that as not a joke, but sort of an extra thing. It's a survey on how that war in Israel may escalate. That's what's going on there. Earnings season. Did I get everything I wanted to share there? Yeah. It's getting better for individual stocks. Last week was actually good to see that there. The average return last week on a stock that reported earnings was 2.3%. Again, that's the biggest. Like you got to go back over 20 years to find a average move of 2.3% or greater based on an earnings report. It just hasn't happened. So it's really good news for that as well. The theme continues of all the stocks that reported earnings. Those that reported that they would raise or were more optimistic about their forward guidance or the future, that they just use the word guidance, those stocks did the best. 7% average returns on the day that they reported their earnings. So that's the theme. People are looking, it's fine. Well, okay, earnings are whatever they are now. You're holding your margins, everything's good. Tell me about the next quarter and a quarter after as we get into potential higher rates that are sticky or maybe rate cuts there. So bouncing around a little bit today, but just thought that'd be fun to share. Stocks in the news. And then remember, the week is going to pick up really quick. So today, a little bit quiet, but it's going to pick up really quick with earnings. Tyson, do you have some Tyson foods? Tyson, in particular, Tyson chicken nuggets in your freezer? You may want to look carefully there. They have foreign objects potentially there. So that was weighing on the stock a little bit today, as it probably should. Chevron. Barron's is popular for kind of putting their stuff out there over the weekend when it comes to individual stocks. They said that Chevron is officially beaten down enough, given the recent earnings that have come out. And of course, they're buying Hess, right? So they said that stock has adjusted its price to now what they call fair value. Have you ever heard of Blue Green Vacation? They're everywhere, man. I mean, in Florida, you can't not know them. Blue Green Vacations, kind of a timeshare thing that they do. They're getting bought out by Hilton Vacation Group. So for $75 a share, and that's what you have going on there. The ticker symbol for Hilton Hilton Grand Vacations. So that if you saw that stock today, HGV, that is their ticker symbol, not Hilton Worldwide. Other than that, Vertex was kind of interesting here, hit new highs today. Vertex is working on a non-addictive opioid, basically a painkiller that you can't get addicted to. They're calling it VX-548. There's no fancy name for it yet, but they've made it the furthest. I don't normally find biotech interesting. I actually spent some time on this one because they're the ones to make it the furthest. Other companies have done this too. They just haven't gotten to a point where they could say, yeah, this is something. They're working on, of course, proving the fact that it won't be addictive, but they've made it the furthest. That they were rewarded today. That would be pretty cool if they could solve for that, because what do they say? 1 in 2 Americans is taking opioids or something, or 1 in 4, something just crazy. What else do we have here? So I'll touch on this briefly here. The presidential primary season. It begins January 15th with the Iowa caucuses. I bring it up because we have kind of an offbeat election season starting tonight, right? In a handful of states there, just to fill vacant seats and whatnot. But nonetheless, it'll make the news there. I want to talk about the markets here real quick. Remember that the stock market's returns tend to be weaker when we are in a presidential election year. Let me see if I have something for you. Tend to be a little, I don't have the chart. Oh, I did the sectors instead. Since 1932, the S&P has returned an average of 7% in the 12 months leading up to an election year, 4% in an election year, if you want to, or in the election year, if you want to look at that. If you look at the fundamental side of things, profit growth is typically the focus there for election years there. Valuations tend to move sideways, et cetera. We've covered all this in the past. I thought it'd be fun to go over the tech sectors here. So not there. Let's go here. Defensives, utilities, consumer staples, they outperform. What I'm showing here is the outperformance relative to the S&P. So utilities tend to outperform in an election year by 5 percentage points. For the consumer staples and so on. Tech tends to do the worst, by the way, which, if you think about it, it's kind of setting itself up to do that anyways, because we have obviously a really good year for tech. So even if it just takes a break next year, that would fall into that stat, and you'd say, okay, tech underperformed by 5 percentage points. So just a really, really quick something or other to point out for you, because I saw elections were a trending topic, and it wasn't because of the president, but it was because of the elections that start actually tomorrow. They start tomorrow, maybe. All right, tomorrow also we'll have Dr. Horton reporting earnings. Uber, Akamai, Darden Restaurants, eBay, Gilead Sciences, Occidental Petroleum, and Rivian will be some of the more interesting ones there. And I'll take your questions if you happen to have any questions. As the week progresses, the earnings calendar gets really thick. So we'll spend a little bit more time on that one there. And just a reminder, if you have insurance questions, Chris was an interesting one to get the answers from, right? To be in the dojo for you. Yeah. Love it there. With this quarter's 2+% earnings beats, isn't that smoke and mirrors since analysts lowered? No, I'm saying not the beats. I'm saying the actual performance of the stock. So the stock, it's hey, we're Jazz Wealth. We're a public company. We report earnings and our stock price well, on average between everybody, was 2.3% to the upside there. So the response is what I'm more interested in at this point, instead of saying, oh, well, let's look at all these companies that are missing, beating on earnings, sales are lower, yada, yada. Also, side note, in the Notes from Jazz this weekend, I went through and I said, well, let's just look. Is the economy slowing down? Let's look at what metrics we can. Had a little bit of fun with that one. I was out of town. I thought, well, I'll just have some fun there. And so if you want to see, it is in our Notes from Jazz, available for clients in the portal and archived as well. Yeah. Are you using SMAs or EMAs? I just put them there for you. It's the all simple, and it's 20, 50, and 200. Yeah. The gray lines, somebody liked that a while back. Those are your standard deviations. 2 standard deviations are the current setting on both sides. Just over time, as I see people that comment are like, you say this number, but can you visually show it? And so I just put it there. And it's on everything, no matter where I go. My blue line is always the 50, the green is always the 20, and the red is always the 200. Yeah. Oh, Emmanuel says, I like some of this beaten down stuff, man. I like the beaten down stuff. VF Corp. Okay. You're looking for that to continue. Maybe some news or something coming up. Betting on a failed breakdown there. What is the correlation, if any, between the 10-year bond market auction and the S&P price action? Well, so there's what's normal, and then there's what's kind of been happening. I've actually probably could find the slide there. The correlation between bonds and the market very much spread, and I would also point out that bonds themselves have been more volatile than the S&P, which is the slide grouping that I'm looking for. Well, here is what we did in the past. So we looked at the volatility of bonds versus stocks, and given that the correlation was way out of whack there at that time. And we found that bonds, by TLT as the proxy, much more volatile than the stocks. Typically, stock market and bond prices are very closely correlated, but I would be wrong if I said that that is currently the case. Because it's not. It hasn't been. But getting better. Last week was a good start, right? Very correlated, very much like it should be, or has been. So there you go. All right, I covered everything I want to cover. There's going to be a lot more coming up this week, so stay tuned. I love when I get to show you some of that data from what we shared in the past. What is the market thinking about? What tends to happen? And when it does happen, I find that fascinating because, like the little thing at the bottom says, history doesn't repeat itself, but it often rhymes. We're just trying to understand that a little bit. All right, enjoy the rest of your dark evening now, because it feels like it's dark outside. And we'll see you tomorrow.